Fubo TV shares have collapsed by more than 2/3 from its peak. Should you even touch it with a 10-foot pole? Now, that's a good question. Fubo has been having a very rough beginning of 2021 so far, and things are not looking better for the company at the moment. But even if the current situation is pretty dim, I still believe that there are reasons to be optimistic about the shares. If you own Fubo shares, or if you're wondering if Fubo TV is a company worth buying, please keep watching this video until the end, as we will cover what will happen to the company and if you should buy its shares. Fubo TV is a streaming service that offers TV content to those who don't want to be bound to a cable company anymore, but who still watch the content on TV itself, especially sports and entertainment. There are two reasons why its stock has been pounded recently. The first one is what I'd like to call the comeback of reality, because investors slowly began to realize that stocks that we collectively pushed to the sky back in 2020 may only have been an excuse to avoid losses in other sectors. So now they're migrating their money out of these positions. The second reason is the increasing competition in the sports betting business. DraftKings recently decided to enter in a very similar strategy with another rival streaming platform. This really poured cold water on the remaining shareholders, because essentially sports betting has been the key monetization strategy for the company, because streaming service itself doesn't really generate any significant profits. They have to spend a lot of money to keep the stream going in the first place. I mentioned before that the profits of the sports betting business will take some time to be realized, if ever. And in that case, investors would need even more faith to be put into this company. And if they think that the strategy is somehow under threat, they may not want to risk their capital at all. Also, and this is not a cause in by itself, but because of all this, a group of shareholders decided to sue Fubo TV in a class action lawsuit for misrepresenting its growth. For now, it's unclear what's going to happen and what will come out of it, so we will have to follow up on this at a later date. My guess at the moment is that some kind of settlement will be reached between the parties. But by this point, you must be wondering if I forgot about another key reason why the stock sold off recently. Well, no, I haven't. I just believe that this is not a disadvantage to the stock, but it does represent instead a great opportunity to us, the traders. Recently, the hedge fund Archegos has been forced to liquidate its positions because it didn't have enough money to cover its margins. There's actually a whole kerfuffle with it, but that is the gist of it. That hedge fund had a massive position in Fubo, and when they had to sell this block of stocks, it caused a dip in the stock price by probably $10. In order to understand why this is somehow an opportunity, we have to go back a bit in time. So back in March of 2020, when the stock markets around the world collectively collapsed, most people were spooked, and rightfully so, and decided to avoid stock market at all costs for the eternity. Well, that ended up being a massive fail on their part, because when stock markets are not fundamentally damaged, but just spooked by a sudden freak event, prices have a tendency to regain the losses caused by this event afterwards. That, by the way, has been my entry point for, I would say, 90% of my positions that I still keep to this day. Now, I'm not saying that this is necessarily one of those events, but the massive sell-off is not what the stock usually experiences and should eventually be corrected back to where things were, because the current imbalance in the amounts of buy and sell orders will not last forever. At the same time, if you scroll back just a little bit, you will see that Fubo stock price is sitting right above a previous resistance level that I think has since then become a support level. Because it has been tested once in late March, and it seems like the market doesn't think that the stock deserves to go lower. At this point, it's important to remind ourselves that the fundamental principle in the stock market, that is demand and supply. It's very tempting to think that when a stock collapses, the only thing there is to do is to flee. But that is usually the best opportunity for the traders if we want to enter that stock. It may give us the entry point we need to make sure that our risk is limited or minimized and the profit is maximized. Now, before I continue, I just want to say that this move does have more risk than other trades because there is nothing that says that Fubo stock will not dip lower before getting back to its feet. That would be a risk you'll have to take if you decide to jump in. Needless to say, that trade would be more for those of us who are risk tolerant. If you want to buy the shares, I would suggest a maximum allocation of 1% of your portfolio. Don't go beyond this, because if you get burned, it will really hurt. With at least 30% of your allocation bought in the next few days. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.